Today, we are going to go through how small businesses and corporations use cash value life insurance, because this has been something that has been used by corporations for a very long time, north of 100 years. And it's extremely effective, but the question that always comes up is how and why? How are companies using life insurance? I'll begin with a story that will relate directly to what I'm about to show you. Early on in my career, I was modeling a policy for a construction company. So they were looking at policies on their executives. The company would own the policies, and the owner of the company made a comment. He had owned about 7 whole life insurance products for north of 30 years. And he said, other than the interest in my business, the company that I own, my whole life insurance policies have been my best performing assets. I make a payment into one of them of $12,000. And the growth this year is north of $40,000. Through 2008, that was consistent. It just keeps going up. I don't even have to think about it. That was a major driver to him purchasing policies for the company to own on the executives. So let's look at exactly how companies use these products. It's going to be some neat stuff, and hopefully you can benefit from it as well. So how corporations typically set these plans up is the company, let's say it's ABC Incorporated. ABC Incorporated takes out policies on their employees, typically the executives, but the company can take those policies out on whoever they choose. Let's say we take policies out on Alex, John, and Liz. They are the insureds, meaning the company is going to own the policies. The life insurance piece goes on these 3. So they may have to go through a medical exam. They have to sign off on paperwork saying, yes, the insurance is on me. If they die, what happens? A life insurance death benefit is paid out. The contribution of these policies is made by the company. The company may elect to pay in $50,000 per year, $1 million per year. Really depends on how much the company wants to allocate toward these policies. The cash value that builds up in the products is an asset on the company's balance sheet. They have access to that cash value anytime they want. These policies are always designed where you have very rich cash values right off the bat. The death benefit, in the event one of the employees dies, the death benefit flows back to the corporation, ABC Incorporated in this example, income tax free. So, sounds good thus far for the company. Let me ask this. If you are Alex, or if you're Liz, you're one of the executives, and I say to you, hey, I'm going to take this policy out on you. It's going to benefit the company. I'm going to fund it, so you don't have to pay anything, but we're going to have cash value on our balance sheet. We're going to continue to grow with our growth mindset. Sounds great. Hey, but if you die, we get the death benefit too. What are you going to think? That sounds great for the company. What's in it for me, though? Are you going to kill me off or something like that? There's only a benefit for the company. Here's the thing. I would say to you, if you're Alex, John, or Liz, if you stay with me for the vesting period, which could be 10 years, maybe it's age 65, perhaps it's performance-based, the company has complete control of setting the terms of this vesting period. If you stay with me, John, what's going to happen? I'm going to pay you a retirement benefit. And this benefit is going to be $100,000 per year. The benefit can be any dollar amount. Again, this is determined by the company and also the size of the policy when we first started. But I'm going to pay you $100,000 per year when you retire, let's assume age 65, until you die, or until age 90. But this is a benefit, almost like a pension, if we want to use that word, that you're going to receive for the rest of your life after you retire. Okay, how's that sound? Sounds good? Sign me up. Here's the catch though. John, if you leave the company, or if you do not meet that vesting period, you don't get that $100,000 per year. It's out the window. So this creates what we call in the industry golden handcuffs. It locks the key employees in and makes it very difficult for them to leave. Really, it's a retention and then reward strategy. If you stay with me at the company and help us continue to grow, because as an executive, I don't want you to leave because you're really driving revenue for the company. That's the advantage to me as the business owner. As I look at key people in my company, for example, we want to retain them, but then at the same time, for the time and effort they put in, yes, they get bonuses, pay increases, all that good stuff, but here is an additional reward at the end because you're committing to stay with me for the rest of your working years. If you leave to go work for the competition, to start your own business, whatever it might be, you walk away from that retirement benefit. And the older they become, the more experienced they become, the more likely it is they can make it on their own as they gain experience with time. It becomes more and more challenging to walk away from that benefit because they get closer to retirement. So a great retention and reward strategy. To build some additional awareness though, here's some questions that often come up. 1, the cash value. As a business owner or corporation, am I just feeding these policies and letting it sit there and eventually going to use it to pay a retirement benefit? That's the primary purpose. However, the cash value is an asset on the company's balance sheet, meaning the company can access that cash value, can assign it as collateral with a bank or a lender to obtain a line of credit. That money can be used to continue to grow the business over time. Opportunity cost, that's the most valuable thing for a business owner, small or large business, company, whatever. So the cash value is accessible all the way through to the policy owner, which is the company. Retirement benefit. John retires. When he retires, he's no longer driving revenue for the company. Do I want to pay him from company profits or company revenue? Ideally not, because he's no longer producing income for the company. So typically, how a benefit is paid here is it's paid from the cash value. So I've built up this big bucket of cash value, and specifically what the corporation will do here is they will take a distribution from the cash value to pay the retired executive. John in this case. So when that distribution is taken from the cash value to the company, that can be a withdrawal or loan, not taxable to the company, but when they pay that retired executive, John in this case, it is booked as a compensation expense, which does trigger some tax deductions there, which is a nice feature. Now, the contributions, however, are not tax deductible. I do want to be very clear on that. But when that benefit is paid, it is paid from the cash value. The death benefit, always paid out tax-free, and these plans are always set up where we do not drain the death benefit. So when we are taking income from the cash value to pay that retired executive, John in this case, Alex, Liz, whoever, I always want to make sure that a death benefit is left intact. So let's say John kicks the bucket at age 90, right? He makes it all the way to 90. I'm going to make sure that a death benefit is set up to recover all costs. What that means is if the company paid $100K per year for 10 years, how much is that? $1 million total. Now granted, they had access to the million all the way through and a lot more because the cash value built up, but I wanted to make sure that that full $1 million is paid back to the company through the form of a death benefit, which is tax-free, and I also want to account for inflation. Typically 3 to 4% is achievable based on companies' present dividend rates, even a conservative dividend rate, but I do want to factor in inflation because we're thinking long range with the eventual death benefit coming back to the company. And then one last question here that comes up. What if John leaves? What if he gets the vesting period, maybe it's till age 65, but he leaves at 55 because he says, you know what, I'm fed up, I'm going to go start my own company, or I'm going to go work for a competitor, and I don't care about the retirement benefit. Because this happens. So in a case like this, a company would A, have the option to keep the policy on John. Eventually, when he dies, the death benefit still comes back to the company. But option B, a lot of people aren't aware of this. It's a really neat trick. It's not really a trick. When John is replaced, another executive takes over his role. We can actually transfer that policy to the new executive. So for example, if the new executive is going to be Joe Joe replaces John because John leaves. Let's say he leaves 10 years after I start the policy. We can take that 10-year-old policy and transfer it to Joe. The cash value, 10 years old, compounding, is transferred over to Joe. Same thing with the life insurance benefit. Joe has to go through underwriting at that point in time, but we are not starting brand new, and we do not need to go through the initial underwriting again, insurance expenses, none of that stuff. I'm sorry, we do need to go through the underwriting, but not the initial insurance expenses. This is actually something this transfer of insured rider is exercised with corporations. You see it done a lot with professional ball clubs, professional sports teams. When they're trading players, when they trade a veteran and they get a new rookie in, they can take a new policy out. But what's the worst part about any whole life insurance policy? The first year. Even with these policies, if we make a payment, if it's $100,000, I might see 90 to 95% of that payment in the first year. But that's still a negative hit on my balance sheet, no matter how I slice it. What's the best part about a whole life policy? Every year after the first year, I get more and more money back each year relative to my premium and PUA payments. It's compounding between 3 to 5%, tax-free if you do it right too. So I am much, much better off taking, if John leaves, taking that 10-year-old policy, or however old it is, and transferring it over to Joe. Now I don't lose time, and I can keep things moving forward. So, hope you enjoyed that one. Hope you found it valuable. If you enjoyed it, please hit the like button, subscribe for more, and we'll talk to you soon. Hope this helps. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.